Right now, as you're watching this, the United States government is creating $3.8 billion every single day, not for stimulus checks, not for infrastructure, not even for war. They're pumping it into the financial system just to keep the lights on. In the past year alone, $1.65 trillion, that's a 1, a 6, a 5, and 12 zeros, has been injected into the economy. That's more than the entire economy of Canada. And here's the crazy part. Most people have no idea it's happening. By the end of this video, you're going to understand exactly where this money is coming from, why the Fed has no choice but to keep printing it, and most importantly, what it's doing to your savings, your rent, and your future. Because this isn't some abstract Wall Street problem anymore. This is about to land in your kitchen. Stay with me. Part 1. The machine that makes money. Let's start with the basics. When economists talk about money supply, they're tracking something called M2. Think of M2 as all the money that's easy to spend right now. It includes the bills in your pocket, the money in your checking account, your savings account, and something called money market funds. Money market funds are basically parking spots for cash that pay you a tiny bit of interest while you decide what to do with it. Why does M2 matter? Because it's the best way we have to measure how much money is actually floating around in the economy, ready to be spent. When M2 goes up, there's more money chasing the same amount of stuff: cars, houses, groceries, everything. When M2 goes down, there's less money competing for those same things. Now here's where things get weird. For almost 40 years, M2 only went in one direction: up. Every year, like clockwork, the money supply grew. Then came 2022, after the pandemic, when the government had dumped trillions into the economy. Something unprecedented happened. The money supply started shrinking. Between April 2022 and March 2023, M2 dropped by about $400 billion. That might not sound like a lot, but in the world of central banking, it was like watching water flow uphill. Why was this such a big deal? Because in the entire history of modern money tracking, M2 had only contracted a handful of times, and every single time it did, something bad followed. The Great Depression, severe recessions, financial crises. So when traders saw M2 dropping, alarm bells started ringing. Markets got nervous. The Federal Reserve said this was intentional. They were fighting inflation. They had printed too much money during COVID, prices went crazy, and now they needed to pull some back. They called it quantitative tightening. It just means they were trying to delete money from the system. And for a while, it worked. Inflation started coming down from its peak of 9%. The Fed declared victory. Jerome Powell went on TV and talked about being appropriately restrictive. Translation: we're squeezing the economy on purpose to cool it down. But then, something broke. By early 2025, M2 stopped shrinking. In fact, it reversed course completely. Hard. From the low point to December 2025, M2 exploded by $1.65 trillion. It went from around 25 trillion to 26.7 trillion. Let's put that in perspective. $1.65 trillion. That's more than the entire GDP of Canada, South Korea, or Spain, and it appeared in basically the blink of an eye. Break it down further. $116 billion per month. That's about $3.8 billion every single day. While you sleep, while you work, while you scroll through your phone, the money printer is running at $3.8 billion per day. Now here's the part that should make you sit up. This isn't pandemic stimulus. This isn't the government sending out checks. This is what they call internal financial plumbing. That's Fed speak for the system is broken and we're holding it together with duct tape. Something inside the machinery of American finance is leaking badly, and the only way to keep it from exploding is to keep pumping money in. The Fed isn't doing this because they want to. They're doing it because they have to. What broke? What is so broken that it requires $3.8 billion a day just to keep functioning? Part 2. The leaky plumbing problem. Here's the contradiction nobody in power wants to talk about. Throughout 2024 and 2025, Jerome Powell kept insisting that monetary policy was restrictive. But if that's true, why is the money supply exploding? You can't be restrictive and create $116 billion a month at the same time. The truth is, the Fed got caught in a trap. They're trying to fight two enemies at once: inflation and a liquidity crisis. And you can't fight both. If you squeeze too hard to kill inflation, you starve the banking system. If you keep the money flowing to save the banks, you feed inflation. To understand this trap, we need to talk about the repo market. Repo is short for repurchase agreement. It's basically the overnight lending market where banks borrow money from each other to cover their short-term needs. Think of it like a 24-hour payday loan for trillion-dollar banks. Every night, banks with extra cash lend it to banks that need it, using treasury bonds as collateral. When the repo market is healthy, these overnight loans happen smoothly at low, stable interest rates. But when something goes wrong, when banks don't have enough reserves, the interest rate can spike. And when it spikes, it can spike violently. That kind of chaos can freeze the entire financial system. This almost happened in September 2019. The repo rate suddenly jumped to 10% in a single day. Banks were scrambling. The Fed had to step in with emergency funding to prevent a meltdown. Fast forward to October 2025. The warning lights started flashing again. The Fed has a tool called the Standing Repo Facility, or SRF. It's basically an emergency window where banks can borrow cash overnight if they're running low on reserves. But in October 2025, usage of the SRF hit $29.4 billion in a single day. That was the highest level in over 20 years. This tells us that banks were running critically low on reserves. They were so short on cash that they had to go begging to the Fed for emergency funding. Why were banks running out of reserves? Because of quantitative tightening. The Fed had been trying to shrink the money supply to fight inflation, draining reserves from the banking system. But they pulled too much. The banking system needs a certain baseline level of reserves to function smoothly. When you cross below it, things start breaking. Fast. And that's exactly what happened. The Fed pushed too hard, the banks hit the reserve floor, and suddenly the system was on the edge of another repo crisis. So the Fed had to stop. They had to reverse course. Not because they wanted to, not because inflation was under control, but because if they didn't, the banking system was going to seize up. This is what lender of last resort means. The Fed's job isn't to make your life better, it's to keep the financial system from imploding. And in October 2025, they had to flood the system with liquidity to prevent rates from exploding and banks from collapsing. This wasn't a policy choice, it was emergency maintenance. And here's the kicker, this is now permanent. The system has become dependent on constant liquidity injections. Every time the Fed tries to step back, something breaks. They're stuck in a cycle where they have to keep pumping money in just to keep the machine from falling apart. Part 3. Stealth injections. So how exactly did the Fed inject $1.65 trillion while claiming they were being restrictive? This is where the magic trick happens. In late 2025, the Fed started doing something they called reserve management. Sounds boring, right? But what it actually meant was they started buying treasury bills again. Treasury bills, or T-bills, are short-term government IOUs. When the Fed buys them, they create new money out of thin air to pay for them. That money flows into the banking system, boosting reserves and increasing liquidity. Now, technically, the Fed said this wasn't quantitative easing. QE is when they buy long-term bonds to stimulate the economy. This was different, they said. This was just buying T-bills to make sure banks had enough reserves. But here's the thing. Money is money. When the Fed creates new dollars to buy assets, that money enters the system. It shows up in bank reserves. It flows into money market funds. It boosts M2. The label doesn't change the effect. So while the Fed was publicly insisting they were still tightening, still being restrictive, they were quietly buying billions of dollars worth of T-bills every week. It was a stealth injection, and it directly offset all the tightening they claimed to be doing. But the T-bill purchases were only part of the story. The bigger driver of M2 growth was a massive surge in money market fund inflows. In 2025, people and institutions poured money into them at record levels. Why? Because interest rates were still high. Money market funds were paying 5% or more. Where did all that money come from? Some came from people pulling cash out of the stock market. Some came from businesses parking their cash somewhere safe. But a lot came from the banking system itself, as reserves got recycled through the financial plumbing. When the Fed buys T-bills, that money doesn't disappear. It flows into bank reserves. Those reserves get lent out or moved around. A lot ends up in money market funds. Those funds use that cash to buy more T-bills. The cycle repeats. It's a feedback loop. The Fed injects liquidity to stabilize reserves. That liquidity flows into money market funds. Those funds grow M2. The Fed sees stress and injects more liquidity. Round and round it goes. And here's the problem. Every time they inject money to fix one leak, it creates pressure somewhere else. Every fix creates a new dependency. The system now needs constant money just to stand upright. Think of it like a drug addiction. At first, you take the drug to feel good. Then you take it to feel normal. Then you take it just to avoid feeling terrible. The Fed started injecting money to prevent a crisis. Now they inject money to prevent the last injection from wearing off. They're trapped. If they stop, the banking system collapses. If they keep going, they feed inflation and distort markets. There's no clean exit. This is how the Fed injected $1.65 trillion, not through some grand stimulus plan, but through emergency patches, workarounds, and quiet interventions designed to keep a broken system from falling apart. And now, that system depends on those injections. It can't function without them, which means the money printer can't stop. Part 4. The price of easy money. So, the Fed is creating $3.8 billion a day to keep the financial system alive. That's a Wall Street issue, right? Wrong. This is where the story stops being abstract and starts landing in your life. Because all that money doesn't stay locked up in the banking system, it leaks out. It flows into the real economy, and when it does, it makes everything more expensive. There's a rule in economics proven over and over throughout history. When the money supply grows faster than the economy, prices rise. It's not instant. There's a lag, but it's inevitable. More dollars chasing the same goods means those goods cost more dollars. M2 growth is what economists call a leading indicator for inflation. When M2 surges, inflation follows 6 to 12 months later. It's like watching storm clouds roll in. You know the rain is coming. You just don't know exactly when. And right now, those storm clouds are massive. We already lived through one wave of inflation in 2021 and 2022. Prices jumped 9%, the highest level in 40 years. The Fed responded by jacking up interest rates. And for a while, it worked. Inflation cooled to around 3%. But here's the thing. Inflation doesn't die easy, especially when you keep pumping money into the system. The risk we're facing now is what analysts are calling a second wave. And the scary part? We've seen this before. In the 1970s, back then, inflation hit hard in 73 and 74. The Fed fought it, inflation came down, everyone breathed a sigh of relief. But then, it came back in 77. And then again, even worse, in 79 and 80. It was a triple peak pattern. Each wave was harder to fight than the last. And the reason it kept coming back? Because the Fed kept easing too soon. Every time they thought they had inflation under control, they loosened policy again. And every time they did, inflation roared back. Sound familiar? Right now, the Fed is trying to have it both ways. They're keeping rates elevated to fight inflation, but also injecting massive liquidity to keep banks stable. They're stepping on the gas and the brake at the same time. And history tells us how this ends. The inflation doesn't die. It just goes dormant, and then it wakes up. So what does that mean for you? It means your purchasing power is eroding. Every dollar you have saved buys less than it did before, and it's going to buy even less in the future. Say you have $10,000 in a savings account. Inflation is running at 4%. Your savings account pays maybe 1% interest. That means you're losing 3% a year in real terms. Your money is slowly evaporating. And it's not just savings. It's everyday expenses. Food prices are sticky. Ground beef that used to cost $4 a pound now costs $7. Eggs that were $2 a dozen are now $4.50. And with another $1.65 trillion sloshing around, those prices will keep climbing. Service prices are even worse. Haircuts, car repairs, plumbing, daycare. Once those prices go up, they never come back down. Middle-income households are getting crushed. If you're making $50,000 or $60,000 a year, you're feeling this every day. Your paycheck might go up 2 or 3%, but your rent goes up 5%. Your groceries go up 6%. Your car insurance goes up 10%. You're falling behind. And even if your paycheck does go up, it doesn't feel like you're getting ahead, because you're not. You're just treading water, running faster just to stay in place. This is what inflation does. It's a hidden tax. It's a slow erosion of your standard of living. And the root cause is the money supply. It's the $3.8 billion a day leaking into the real economy and making everything more expensive. The plumbing fix isn't just a banking problem. It's leaking into your kitchen, into your rent check, into your savings account. Part 5. The fake boom. But wait, if all this money is flooding into the economy, shouldn't something be booming? Well, something is booming, just not the things that matter to most people. All that excess liquidity doesn't spread evenly through the economy. It doesn't trickle down to Main Street. It pools in certain places. And those places are what Wall Street calls risk assets. Risk assets means stocks. It means crypto. It means real estate in hot markets. It means anything speculative, anything that can shoot up in value if enough money chases it. And that's exactly what's happening. Throughout 2025, even as the real economy struggled, GDP growth weak, unemployment ticking up, consumer spending soft, the stock market kept climbing. The S&P 500 hit new all-time highs. Tech stocks soared. Bitcoin went on another run. On the surface, it looks great. Wealth is being created, right? People's retirement accounts are going up. Homeowners see their property values rise. But here's the problem. None of this is real. It's not based on actual economic growth. It's not based on productivity improvements. It's not based on companies making better products. It's based on liquidity. It's based on the Fed pumping money into the system, and that money flowing into assets because there's nowhere else for it to go. This is asset inflation. And it's different from normal inflation. Normal inflation is when the stuff you buy gets more expensive. Asset inflation is when the stuff you invest in gets more expensive. And the two don't always move together. You can have a situation, and we're living in it right now, where stocks are soaring but wages are stagnant, where home prices are up 20% but people can't afford groceries, where billionaires are getting richer and the middle class is getting squeezed. This is the K-shaped economy. If you own assets, stocks, real estate, businesses, you're on the line going up. Your wealth is growing. The system is working for you. But if you rely on wages, if you're living paycheck to paycheck, if you don't own assets, you're on the line going down. Your real income is shrinking. Your purchasing power is eroding. The system is leaving you behind. And here's the cruel irony. The Fed's money printing is making this worse. Every dollar they create to save the banking system flows into assets first. It bids up stock prices. It bids up home prices. It makes the rich richer. Meanwhile, the inflation that eventually leaks into consumer prices hits the poor and middle class hardest because they spend a bigger share of their income on necessities, food, gas, rent, which are exactly the things that get more expensive. So the liquidity injections create a double whammy. Asset owners win, wage earners lose, inequality explodes. And this isn't just an economic problem, it's a social problem. When you have an economy where half the country is doing great and the other half is drowning, you get tension, you get anger, you get political extremism. People stop believing in the system. The rich blame the poor for being lazy. The poor blame the rich for being greedy. The left blames corporations. The right blames the government. And nobody's looking at the real culprit. A financial system so broken that it requires constant money printing. And that money printing is tearing society apart. This is the fake boom. Markets are up. Wealth is being created. But it's all built on a foundation of printed money and financial engineering. It's fragile. It's unstable. And when it cracks, and it will crack, the people who get hurt won't be the billionaires. It'll be everyone else. The money fixes the markets, but it breaks society. Part 6. The Trap of 2026. So here we are, early 2026. The Fed has injected $1.65 trillion. The banking system is stabilized, at least for now. The stock market is near all-time highs, and inflation seems under control at around 3 to 4%. Everything's fine, right? Not even close. What we're looking at now is something economists call stagflation light. It's not full-blown 70s stagflation, but it's close enough to be terrifying. Stagflation is when you have stagnant growth and persistent inflation happening at once. Usually, when the economy is weak, inflation falls because demand is low, and when inflation is high, it's because the economy is growing fast. But stagflation breaks that rule. You get the worst of both worlds. The economy barely grows, jobs are scarce, wages don't rise, but prices keep going up anyway. And that's exactly where we're headed. GDP growth in 2026 is projected below 2%. That's weak. The labor market is softening, hiring is slowing, companies are hesitant to invest, consumer confidence is shaky. But inflation? Inflation is refusing to die. Despite elevated interest rates, despite all the talk about being restrictive, prices are still climbing at 3.5 to 4%. Food prices are sticky, service prices are sticky, rent is sticky. Why? Because of the $1.65 trillion. Because the Fed is trying to fight inflation with one hand while pumping money with the other. And now they're trapped. If the Fed stops injecting liquidity, if they actually follow through on being restrictive, the plumbing breaks again, reserves drop, the repo market seizes up, banks fail, we get a financial crisis. But if they keep injecting liquidity, inflation stays alive. It doesn't spike to 9% again, but it doesn't fall to 2% either. It just lingers. And over time, that lingering inflation compounds. This is the Fed's trap. And it's your trap too, because you're the one who pays for it. Not the bankers, not the hedge fund managers. You, the person trying to pay rent, the person trying to buy groceries, the person trying to save for a house. Let's make this personal. Rent. If you're a renter, you know rents are up 15 to 25% compared to 3 years ago, and they're not coming down. Food. You go to the grocery store and do the math. You used to spend $100 a week. Now it's $150. You're buying the same stuff, but it costs more. Debt. If you have credit card debt, car loans, student loans, you're drowning. Interest rates are still high. Your monthly payments are eating up more of your paycheck. Savings. You're trying to save, but every month something comes up, and even when you do put money away, it loses value. And the future? Buying a house feels impossible. Retirement feels like a fantasy. You're just trying to make it through this month. This is what $3.8 billion a day looks like when it lands in your life. It's your rent going up, your groceries costing more, your savings shrinking, your future slipping away. And here's what makes it worse. There's no painless way out. The Fed can't stop printing without crashing the system. But they can't keep printing without making inflation worse. They're stuck. And you're stuck with them. This is the trap of 2026. The machine that makes money can't stop. But every $1 billion it creates makes your life a little bit harder. The plumbing is broken, and instead of fixing it, they're just pouring more water into the leak. The question isn't whether this ends badly, it's how badly and when.